Is it the central bank's fault or is it the government's fault? Someone needs to make sense of this. Lucky for you, here I am. I live to serve. Welcome back to Contemporary Issue Wednesday. Last week, guys, I talked about central banks. I described what they do, and I described some of the issues around their leadership and the people in the position of power in these institutions not being directly accountable to the electorate, but being appointed. And so does that raise some issues about accountability with the central bank institutions? Is too much power being placed in the hands of unelected officials? Talked about that last week. What I want to argue today is that the criticisms that are often leveled against central banks are unfair criticisms, because lately, since maybe the 2008 financial crisis, central banks have had to take an outsized, a larger role in the economy than they were originally designed to take, because the fiscal side, that is the governance, the governments of Western society, have not taken on adequate responsibility, have not instituted enough economic policy and economic progress on their end. So here's the argument in a nutshell. People say that central banks have taken too much of a role in the economy, that quantitative easing, that buying up government bonds, that lowering interest rates to the point that they have been lowered is too much, that the central banks, particularly in so-called free market societies, should not be taking this much of a heavy-handed approach, interventionist approach, you might say, into the economy. Alongside this criticism, there is also another one which says that the instruments that central banks have for affecting the economy primarily affect the stock market, the financial systems of Western societies, of Western economies. Now, the problem that many people have with this is that when central banks just open up the floodgates and let capital and liquidity flood the stock markets, well, the stock markets recently have been very bad instruments of actually trickling down that money into the rest of society. They're not the greatest instruments of strong, sustainable economic growth for a number of reasons, which I'll get into on a later episode on financialization. But what we need to know for today is this criticism says that central banks, when they try to But what we need to know for today, ladies and gentlemen, is that the criticism is central banks and their primary instrument of flooding markets with capital really only benefits one segment of the population, and that is the segment of the population that has a lot of capital, a lot of money in the stock market, which is usually very well-off, prosperous people. I don't know if you know this, but a lot of poor people don't have a lot of money in the stock market, so they're not seeing as much or nearly as much as a gain as people who have a lot of money in the stock market. And so that's one of the other criticisms of central banks, and there's many more. Now, what I want to argue, and what many central banks have argued, including the former chair of the Federal Reserve, Ben Bernanke, is that because the governments of Western societies in America and Europe haven't actually been able to put forth good, long-lasting, effective, sustainable governance and fiscal policy, central banks have had to take a step up to fill in the gap left by inadequate fiscal policy. So what do I mean by fiscal policy? Well, fiscal policy, simply put, is basically the government's ability to affect the economy. There's many different ways the government can affect the economy. They can collect more taxes, they can redistribute wealth in some way, they can make structural changes to the economy and how the economy should be wired. Should there more emphasis be placed on the stock market? Should more emphasis be placed on infrastructure spending? Should more emphasis be placed in X, Y, or Z market? And they can kind of push policy into the direction of shaping the economy. And so there's many, many different tools that federal governments, that national governments can use to affect the economy. And all of these tools come under the head of fiscal policy. Now, the argument that I want to make is that these national governments have been so ineffective in their fiscal policy that central banks have seen the ineffectiveness or the inefficacy of this fiscal policy and have had to step up to fill the gap. Now, nowhere is the inability of a government to come together and actually promote a unified fiscal policy more evident than in the Congress of the United States of America. That's right, ladies and gentlemen. Congress has been in a state of almost continual stalemating over taxes, over spending, over tightening up the budget, over fiscal policy. Now, this stalemate has gotten so severe at certain points that the federal government has literally been brought to a standstill. That is, the disunity in the stalemate in Congress has gotten to such a low point that the federal government, on one occasion at least, has had to shut down. I mean, imagine that. That's how bad the ability for Congress to get together, bipartisan support for a fiscal policy. It's been so bad that the government has literally had to shut down at one point. So that just gives you a little inkling into the failures of the American central government. If we look at Europe, the big problem with Europe is structural. All of the countries are under the umbrella of the euro. They share the same currency, and they have the European Central Bank. The problem here is political. The notorious problem in the EU, at least from my eyes, is the balance between we want to create a unified currency, we want to have a unified Europe, and we want to preserve the sovereignty, the individual political sovereignty of different states. That's primarily what Brexit was about, and that's one of the core tensions, core issues of the EU. So how does this affect fiscal policy? Well, it's really difficult to get all 27 member states of the EU to come together and agree on any sort of similar across-the-board fiscal policy. The case in point here would be Greece. Remember, Greece faced financial ruin, bankruptcy, and an exit, a Grexit, from the European Currency Union. Now, many economists in Europe and around the world thought that the solution to the Greek crisis was to bail out the Greek government, to bail out the Greek state and the banks, and to give them the money to fund all of their pensioners, to fund the government workers, to fund a stimulus and infrastructure spending. Other economists and other governments, most notable among them being Germany, thought that the solution was austerity, tightening up the belt, and said, hey, Greece, the reason you're in this whole conundrum in the first place is because you overspend. So if we bail you out, if we agree to give you the money to survive in the European Union, then you have to agree to very, very tight austerity. So you can see how even just this one example presents a lot of divergent opinion within the European Union, and it makes political consensus about fiscal policy across the European Union very, very difficult to come to. And so these two examples, Congress in the United States, the European Union in Europe, demonstrate that there has been a gap, a hole, a lacking of fiscal policy, of political solutions to our economic problems. And I haven't even gotten into the failure since the 2008-2009 financial crisis of actually instituting structural changes to the economy to avoid the kind of overloading and the kind of excessive risk-taking. And so fiscal policy in the form of reforming the tax code and setting tax rates and understanding and coming to a consensus of the amount of infrastructure spending, of austerity, all of these things and more, making structural changes to the economy, all of these things and more make fiscal policy very difficult in a very polarized political environment that we find ourselves in right now. And so because of this, central banks have had to step up their game, in a sense, have had to step up in their responsibility. And they've taken this on themselves because they say, hey, look, if the governments, if the fiscal policies can't do it, someone will have to do it because something needs to be done, particularly, again, out of the 2008 financial crisis. All right, guys, that's it for today. What are your thoughts? What are your opinions about central banks and their role? Is it too inflated? Should they play more of a role? What do you think about fiscal policy? Let me know. Share the videos. Subscribe to the channel, guys. We're growing ever so slightly, but we're growing. And remember, reality always trumps ideology.